Welcome back to the deep dive. Today we are plunging into the world of packaged foods, specifically focusing on a giant that's feeling the heat right now,
Hmm.
ConAgra Brands, Inc.
Right. You probably know them better, though, as the people behind Bird's Eye, Slim Jim, Healthy Choice, Marie Callender's,
Mm.
lots of household names.
Exactly. So our mission today is pretty straightforward, but I think crucial. ConAgra's gone through this massive multi-year strategic transformation. They've really pivoted the whole company identity.
Huge changes, yeah.
But they're currently battling some severe operational challenges. We're talking historic inflation, persistent volume loss, supply chain stumbles, the works.
It's a tough environment.
So we need to analyze all that turmoil. We need to figure out why this company, which owns these deeply established household brands, has a stock valuation that basically screams distress.
Mm.
Is this a classic value trap just waiting to snag unwary investors? Or maybe is it a genuine, compelling, contrarian opportunity for people willing to wait out the storm?
It is absolutely a fascinating time to study this company. We are looking at a classic case of a corporate giant at what the sources are calling a critical inflection point.
Inflection point, okay.
Yeah, on one side, they have incredible proven brand equity. I mean, these are assets that have been in your pantry and freezer for decades, right?
Really?
But on the other side, they are stacked against significant operational execution risk. And that's risk that management hasn't, let's be honest, fully overcome yet.
Right.
The market is basically expressing deep fear and frustration. It's refusing to give them the benefit of the doubt right now.
So pessimism is high.
Extremely high.
Yeah.
And if you need just one fact to sort of frame this entire deep dive to understand the inherent tension here, consider this juxtaposition.
Oh, okay.
ConAgra generates over $1 billion in free cash flow annually, and they boast a remarkable history. They've maintained a dividend payment for 50 consecutive years. 50 years.
Wow, that's consistency.
It is. Yet, the market's deep pessimism, it's reflected right there in its current valuation multiples. That strong dividend yield is sitting at over 7.5%.
7.5% yield.
Yeah, and the price-to-earnings ratio is trading near multi-year lows, hovering around like 7.9 times.
Okay, that's low for this sector.
It's very low. So that wide disparity high cash flow generation paired with extreme market skepticism, that's the core contradiction we really have to unpack today. Hashtag Tag 2, company overview and strategic transformation.
Okay, let's definitely unpack this transformation first. Because the company ConAgra is today is, well, fundamentally different from the company it was even a decade ago, right?
Completely different. For years, it was this massive, sprawling entity.
Yeah.
Part commodity broker, part agricultural processor. It was all over the place.
Right.
The strategic shift has been very deliberate, aiming to turn it into what the sources call a pure-play, brand-centric food enterprise.
Brand-centric.
Okay. Yeah, they're focused intensely on consumer packaged goods now, CPG, where the brand itself holds the value, rather than just, moving bulk commodities around.
Makes sense.
Exactly. And to really understand the business after this pivot, we have to look at how the revenue and profit concentration plays out.
Where's the money coming from?
Pretty much. The vast majority of sales and, crucially, the operating profit, the real beating heart of the company comes from the U.S. domestic segments.
So it's mainly a U.S. story still.
Overwhelmingly. Looking at the fourth quarter of fiscal 2025 gives us a really great snapshot of this concentration. Their largest segment is grocery and snacks.
Okay.
That pulled in $1.2 billion in Q4 FY25 sales. That's what, 43.1% of their total?
Almost half.
Yeah. This is where you find those iconic impulse-driven names like Slim Jim Meat Snacks, Orville Redenbacher's Popcorn, and maybe the slightly trendier Angie's Boom C Shikapop.
Got it. Snacks and staples.
Right. The major challenge here, though, is that this is the really intense battleground, the center aisle of the grocery store. You've got constant price competition and increasingly really sophisticated private label products coming from the retailers themselves.
Yeah, store brands are getting better and better.
They really are.
And then you have the other heavy hitter segment, the one they're kind of banking on for strategic growth. Refrigerated and frozen, or R&F, right?
That's the one, R&F. That segment was just slightly smaller, hitting $1.09 billion in Q4 FY25 sales, so about 39.2% of the total.
Still huge.
Oh, yeah. And this is truly the core of their strategic focus. This is where they believe the future is supposed to be forged.
Why there specifically?
Well, R&F is home to some absolute powerhouses. You've got Bird's Eye Frozen Vegetables, a category leader there, Marie Callender's Healthy Choice Frozen Meals, and, the beloved Ready Whip whipped topping.
Okay, yeah, big names.
Big names, exactly. This is the segment where they've really chosen to double down on powerful consumer trends like convenience, value, and increasingly health. And they had the scale advantage here.
Right.
The remaining segments international, which is about 8.3% of sales, and food service, contributing around 10.1%, they provide some necessary geographic diversification and exposure to the food away from home market, restaurants, cafeterias, that sort of thing.
Okay.
But really, when we talk about ConAgra's operational performance,
Mhm.
like 82% of the discussion centers on those two massive U.S. retail segments, grocery and snacks and R&F.
Got it. So this strategic pivot, it brings us to the actual mechanics of how they change things. You mentioned divestitures combined with smart bolt-on
Right.
acquisitions.
That's the playbook. Pruning the old to plant the new, essentially.
Okay.
On the divestiture side, yeah, they've let go of some very iconic, reliable brands that were maybe slower growth cash generators, but still.
Yeah.
Names like Chef Boyardee, Van de Kamp's, and Mrs. Paul's frozen seafood businesses.
Okay, I understand the goal is growth, but selling stable, beloved brands like Chef Boyardee, especially right before a period of high inflation, maybe even recession fears, when consumers often seek comfort and stability. Doesn't that sound like, well, potentially catastrophic timing? Did the sources talk about that specific risk? Trading stability for uncertainty?
They absolutely did.
Yeah.
And it's really the crux of the near-term criticism you hear. Management's defense, essentially, is that those brands, while stable cash generators, were actually a drag on the average growth rate of the whole company.
Okay.
And they required high maintenance, high capital investment for what they saw as minimal return. They were often asset-heavy, tied to specific plants, and exposed to volatile commodity costs.
So get rid of the slow but steady.
The goal was to eliminate what they saw as low-margin predictability in exchange for the high-growth, potentially high-margin future of smaller, more agile brands. This is theory, anyway.
And what's this something else they're trading up for? These bolt-ons.
It's really about the uncertain potential of growth in highly specific niches. The cash generated from selling off, say, Chef Boyardee is being recycled into smaller brands, like the recent acquisition of Fady smoked meat sticks.
FAT smoked meat sticks.
It aims to deepen their presence in that high-margin, attractive meat snacks category, which ironically was pioneered by their own Slim Jim. So they're trying to build on existing strengths, but with newer, maybe trendier assets.
So this portfolio reshaping, it sounds philosophically sound maybe, but it carries significant near-term vulnerability, doesn't it?
Precisely. That's the key takeaway. They are exchanging stable, predictable cash flow for the uncertain potential of scaling these new, less proven assets.
Right.
And the success of this move, whether those bolt-ons can meaningfully replace the earnings contribution of the brands they sold and actually achieve better margin profiles that won't be fully apparent for several fiscal years.
So it's a waiting game.
It's a classic high-risk, potentially high-reward gamble. And the market's really depressed valuation right now. It suggests investors are highly skeptical about management's execution capability during this tricky transition period.
Okay, let's pull back a bit and look at the environment ConAgra is operating in. The global packaged food industry. It's colossal, right? Valued at like $3.3 trillion.
Absolutely massive. But in North America specifically, it's fundamentally mature. Top-line growth is modest, maybe low single digits on a good year.
Which means competition must be fierce.
Intense. Everyone's fighting for every fraction of market share. It's a constant battle.
Okay.
And the current macroeconomic trends are creating this really powerful and kind of contradictory set of dynamics for packaged food companies like ConAgra.
Oh, so contradictory.
Well, on one hand, you have historic food inflation, which we'll definitely dig into later.
Oh, yeah.
That's driving consumers to eat at home more often to control their budgets.
Yeah.
Dining out has become exceptionally expensive.
Right.
So this movement back to the kitchen actually benefits packaged food volume. It offers a genuine tailwind for companies like ConAgra. More meals at home means more potential sales.
Okay, that makes sense. So what's the contradiction?
The contradiction is that the same inflation simultaneously heightens consumer price sensitivity to an extreme degree. Shoppers are acutely focused on value. They're scrutinizing every single price tag.
Mm-hmm.
And this makes them more open than ever to exploring private label products, store brands.
Ah, right.
So ConAgra gets the volume benefit from people eating at home, but then they have to spend dramatically more on promotions and marketing just to defend that volume against cheaper store brands. It truly is a double-edged sword.
Volume up, but margin pressure way up too.
Exactly. And cutting across all of this is the relentless structural demand for convenience. This isn't going away.
No kidding.
The sources point out a fascinating detail. The average meal prep time for an evening meal has fallen to a historic low of just 31 minutes.
31 minutes, that's
No,
fast.
it's incredibly fast. And that structural decline directly favors ConAgra's core business. Ready-to-eat meals, frozen entrees, and of course, quick, minimally prepared snacks. Convenience is king.
Okay. And what about health trends? That's always evolving.
It is. And we're seeing evolving health drivers that necessitate a proactive, strategic response from companies like ConAgra. And it isn't just about chasing low fat or low sugar anymore.
What's the new angle then?
Well, a big one is the growing mainstream use of GLP-1 weight loss medications. Think Ozempic, Wegovy. These are starting to structurally influence consumption patterns.
That's a huge point. How exactly are these medications influencing CPG demand? And what's ConAgra doing about it? It seems like a threat if people eat less overall.
It definitely could be a threat, but it's also an opportunity. The impact is kind of twofold. First, yes, GLP-1 drugs work by delaying gastric emptying and suppressing appetite, which results in significant overall calorie reduction. People are simply eating less food overall.
Okay, the threat part.
Right. But second, when they do eat, they're prioritizing nutrient density because their stomach capacity is limited. This is driving demand towards smaller portions and, critically, higher protein content to help maintain muscle mass during potentially rapid weight loss.
Ah, so smaller but maybe higher value portions.
Exactly. And ConAgra is responding proactively here, which I think shows some strategic foresight. They're already labeling certain healthy choice products, specifically the bowls and higher protein items, as GLP-1 friendly, or actively marketing them toward this demographic.
That seems smart, turning a headwind into an opportunity.
It's a brilliant move, potentially, because it turns that potential headwind, people eating less food overall, into a product innovation opportunity. They can focus on high-value, high-protein, smaller portions. If this trend continues to accelerate, ConAgra, with its strength in portion-controlled frozen meals, might actually be better positioned than many competitors who are focused on bulk goods.
Interesting. Okay, now let's deep dive into that strategic cornerstone you mentioned, frozen foods. You said it's not the TV dinner aisle of the 1980s anymore.
Not at all.
The category is undergoing a genuine renaissance, apparently. Projected to grow at a steady 5.0% compound annual growth rate through 2032. That sounds pretty strong for a mature CPG sector.
It is strong, and the perception shift is fundamental. Innovation in freezing technology means frozen is no longer automatically equated with, low quality or just being loaded with sodium.
Right.
Instead, freezing actually allows for better ingredient retention, higher quality. And it's becoming the platform for premium meals, plant-based alternatives, even chef-inspired options.
Plus the convenience factor.
The convenience factor is unrivaled. And let's not forget the sustainability angle either. The longer shelf life dramatically helps consumers reduce food waste, which is actually a major purchase driver, especially for younger demographics.
Good point.
And this is where ConAgra's strategic positioning really shines. They are the undisputed market share leader in the massive $6.4 billion U.S. single-serve frozen meals category. They control the majority of the volume.
Wow, $6.4 billion just for single-serve frozen.
Yeah, it's huge. And that dominance gives them significant scale advantages, huge leverage with retailers for shelf space, and a really powerful platform for innovation through brands like Healthy Choice and Recalendars.
Okay, but you also flagged that category leadership as their biggest vulnerability. Let's talk about that competitive ceiling, the private label threat.
This is the big one. This is the structural issue the market is truly worried about, I think, because ConAgra's Bird's Eye and Healthy Choice are the established market leaders, and they carry a price premium.
Natural.
They are the immediate primary targets for retailers' own private label programs. Think Kirkland Signature at Costco, or 365 at Whole Foods, or Great Value at Walmart.
Right.
And retailers are getting incredibly sophisticated. They're investing heavily in their own R&D to position their store brands to compete directly on quality, on packaging, and critically, always on price.
So ConAgra is kind of trapped, always looking over its shoulder, forced into a perpetually defensive posture, fighting for share just to stand still.
Precisely. That's a great way to put it. They are structurally forced to spend heavily on marketing, on continuous innovation just to keep things fresh, and on in-store promotions simply to defend their existing market share against alternatives that are structurally lower priced. Because the retailer controls the whole supply chain for their own brand. The sources really suggest that any significant profitable growth for ConAgra has to come from successfully innovating into new, higher-margin subsegments, like maybe those GLP-1 focused meals we talked about, where the private label threat hasn't fully developed
Yeah,
yet.
their core profit margins.
Their core profit margins are perpetually constrained by this reality, and that ties back directly to why the stock trades at such a low valuation multiple. Hashtag tag FEF, financial health, execution risk, and the strategic pivot.
Okay, let's move to the financials then.
Yeah.
Because this is where that execution risk really manifests and where I guess the market's deep pessimism comes from.
Absolutely.
We looked at the revenue volatility. You mentioned it peaked in fiscal year 2023 at $12.28 billion, but it's since declined to $11.61 billion in fiscal 2025.
That's right.
And that drop reflects those divestitures we discussed, sure, but overwhelmingly, it reflects volume challenges caused by the price increases they had to push through, right?
Exactly. Pricing protected margin initially, but killed volume. And the instability in reported net income is also really stark. It requires a crucial note on accounting for you listening.
Okay, what's the catch?
Well, while fiscal 2025 reported a strong-looking $1.15 billion in net income, that was largely an accounting normalization. It was primarily due to the non-recurrence of massive non-cash impairment charges that were recorded in the previous year, FY24.
Okay, let's pause on impairment charges because that sounds important. What exactly is an impairment charge, and why does its one-time nature make the reported net income look maybe misleadingly good in FY25?
Right. So an impairment charge is essentially a major financial write-down. If a company buys an asset, often it's the goodwill from a prior acquisition, basically the premium paid over the tangible assets, and later determines that asset is worth significantly less than the price they paid.
Because market conditions changed or the deal didn't work out?
Exactly, or failed integration, whatever. They must write down that value on their balance sheet. This creates a huge non-cash loss in that specific year's income statement.
Oh, okay.
And the sources indicate ConAgra had to take significant impairment charges in FY24, likely related to goodwill from some older acquisitions that just never delivered the expected synergy or growth they hoped for.
So FY24 net income looked terrible because of these big write-downs.
Correct. And FY25 looks great mostly just because those huge charges weren't repeated. It makes the year-over-year comparison look fantastic, but it hides the underlying pressure.
So if you want the true picture,
if you look at the operating margin and the underlying cash generation, you get the real picture of performance pressure, which brings us right to the core financial challenge, this margin crisis created by historic inflation.
and the sheer numbers on this inflation you mentioned are staggering. The CEO called it a historic amount of inflation.
The numbers are brutal. They're forcing a complete recalibration of their entire cost structure. ConAgra projects that the 5-year cumulative net inflation, so the total cost shock absorbed across commodities, labor, logistics, everything, will reach approximately 45% by the end of fiscal 2026.
45%. Cumulative.
45%. Think about the operational challenge of trying to pass along a 45% cumulative cost increase to a price-sensitive consumer without absolutely destroying demand. That is the fundamental problem they're wrestling with.
And the inflation isn't stopping, is it? What are the new headwinds they're facing just for this upcoming fiscal year, FY26?
No, it's not stopping. They are forecasting total cost of goods sold QBS inflation of about 7% for fiscal 2026.
Another 7%. Okay.
And that 7% is composed of two major shocks. First, about 4% in core commodity and operational inflation. That covers things like logistics, packaging, labor stuff that remains sticky and high.
Okay, the usual suspects.
Right. But second, and this is a massive new headwind they flagged, a potential 3% impact, which translates to roughly $200 million annually from new tariffs recently imposed on tin plate steel.
Tin plate steel. That's for canned goods, right? Like Chef Boyardee. Oh, wait, they sold that. But other cans. $200 million is a staggering hit from just one regulatory change.
It is absolutely devastating. ConAgra still has a large canned goods portfolio, think Hunt's Tomatoes, Rotel, things like that. And that tariff is an immediate direct hit to CAGs that they cannot easily negotiate away or quickly reformulate out of.
Wow.
Management has admitted they have a task force basically dedicated to mitigating this, but it puts immediate intense pressure on their margins and their execution ability right out of the gate for FY26.
Okay, so this intense cost pressure is what forced ConAgra to make that highly controversial strategic shift we're seeing play out right now, prioritizing volume over margin.
Correct.
They had aggressively raised prices in the past couple of years, which, you said protected margins pretty brilliantly, but caused volume to just crater.
It did. Consumers walked away.
So now they're explicitly pivoting, prioritize volume recovery, even if it means sacrificing short-term profitability.
This is the moment they took the intentional dive into what they hope is an operational trough.
Ah,
And the guidance they gave on this shift, well, that's why the stock suffered so severely.
because the planned margin compression is...
It's severe, and it's deliberate. They are guiding for the adjusted operating margin to decline from 14.1% in fiscal 2025, which was already under pressure, down to a really depressed range of 11.0% to 11.5% in fiscal 2026.
That is a near 3 percentage point margin erosion in 1 year. On purpose.
On purpose. That's management essentially burning margin dollars to buy back shelf space and consumer loyalty through increased promotions, more advertising spend.
But if they fail to regain the volume, they're just left with lower margins and lower sales. That sounds like a terrifying tightrope walk.
It is absolutely the biggest risk investors are reacting to, and it's why that PE multiple is sitting in the basement. And compounding this margin sacrifice risk are the clear supply chain stumbles, things that demonstrate management's difficulty with flawless execution just during the last fiscal year.
Okay, what specific examples did the sources give?
We really have to look at two specific material disruptions from fiscal 2025 that underscore this internal operational weakness. First, chicken production.
Chicken, okay.
Yeah, the company faced, and I quote, product quality inconsistencies at its main chicken cooking facility. This facility supplies the cooked chicken for a vast array of their frozen meals. Healthy choice, Marie Callender's.
So a critical bottleneck.
A critical bottleneck. This forced them to halt production, then restart slowly, and rely on expensive third-party co-packers just to meet the demand they had. That's a massive cost inefficiency and a sign of operational fragility.
And is it fixed?
They're working on it. The sources warn that the benefits of the modernization efforts they're undertaking now to fix this systemic quality issue likely won't be seen until fiscal 2027. So more short-term pain.
Okay, what was the second failure? You said it was in their supposed strength, the frozen vegetable category.
Exactly. In frozen vegetables, specifically Bird's Eye, the company's marketing and innovation efforts were actually too successful. Demand, quote, blew away expectations.
Okay, that sounds like a good problem to have. Normally.
Normally, yes. But in ConAgra's case, it actually created a crisis. They experienced inventory depletion, major out-of-stocks on retail shelves, meaning lost sales, and they actually had to curtail promotional spending just to allow supply chains to catch up and rebuild inventory.
So they couldn't even capitalize fully on their own marketing success?
They couldn't. They had to scramble just to increase surge capacity.
Okay, so the synthesis here is...
The synthesis is that these disruptions underscore significant systemic execution risk related to their internal operations and capacity planning. It shows that even when demand is there, their current supply chain capacity and reliability are major limitations. Limitations that management must urgently fix to make the entire growth strategy viable.
Because if you can't meet a spike in demand...
You hand market share directly to competitors and, crucially, to those private label offerings that are always waiting on the shelf right next to yours.
Right. But despite all this volatility, the execution issues, the deliberate margin sacrifice, the underlying cash generation remains robust. You said that's the crucial safety net.
It is. It's the ultimate anchor for any contrarian bull case here. ConAgra is still a strong free cash flow generator. They pulled in $1.3 billion in free cash flow in FY25.
Okay, $1.3 billion.
And that FCF is the key distinguishing factor right now. That $1.3 billion strongly supports the dividend. Remember, they paid out $669 million in dividends in FY25. That gives them a comfortable 58% payout ratio based on that FCF number.
So the dividend looks safe for now.
For now, yes. And it also allows them to fund their stated debt reduction priority. They reduced net debt by $364 million in FY25, and they're targeting another substantial $700 million paydown in FY26.
So they're using cash flow to delever, too.
Correct. So while profitability is definitely being squeezed by these operational costs and strategic choices, liquidity and the ability to service debt and pay that dividend are, for the moment, not immediately threatened. That's the cushion. #TAGV. Competitive positioning and innovation.
Okay, so we've established the market is punishing them heavily, execution risk is high, but what's the competitive moat? What keeps them from just being entirely consumed by these cost pressures and that ever-present private label threat?
It really boils down to two inseparable things, I think. Brand strength and increasingly data-driven innovation.
Okay.
First, the brands. They own iconic brands, Bird's Eye, Slim Jim, Marie Callender's, Ready Whip. These create high consumer awareness, significant loyalty, and they still command premium shelf space, even if they have to fight for it.
That brand equity is real, even if it's expensive to defend.
Exactly. It's a significant barrier to entry for newcomers. And then there's their innovation engine, which they refer to internally as demand science.
Demand science. Okay, that sounds like their attempt to turn data into a competitive weapon. Is it specific, or is it just corporate jargon? What does it actually produce?
It's their attempt to gain a crucial edge in a very mature industry. It seems to be more than just jargon. They use a pretty sophisticated data-driven approach to R&D that goes beyond just, traditional focus groups.
So?
They analyze massive pools of consumer data, point-of-sale data from retailers, social media trends, regional purchasing habits to try and identify niche demands really quickly.
Like what sort of demands?
Things like the specific desire for bold and global flavors in snacking, or the exact better-for-you attributes consumers are actually seeking, not just saying they want, or specific convenience needs for different times of day or different demographics.
Okay, can you give an example? How does demand science lead to a product?
Okay, so instead of just launching, say, a generic new flavor of Slim Jim, demand science might tell them that convenience store traffic is rising dramatically in the mid-afternoon, specifically in suburban markets. And those particular buyers are disproportionately seeking products with a specific combination of, say, heat and savory flavor profiles.
Right, very specific.
Very specific. This insight then leads them to quickly develop and launch a new, potentially higher margin Slim Jim variant, maybe something like Fiery Chorizo, that directly capitalizes on that highly specific, identified demand gap.
Okay, I see. Targeting niches identified through data. And does the data show this approach is actually working? Is it bringing in revenue?
It seems to be. The numbers are pretty compelling. New products launched just in fiscal 2025 contributed over $300 million in retail sales.
$300 million from new stuff.
Yeah, and that was a remarkable 27% increase in new product contribution year over year. So they're launching products that resonate and are bringing in meaningful new revenue streams. It shows they can still innovate effectively.
That's the key, relevance. Okay, but now let's talk peers. You mentioned ConAgra competes directly with companies like General Mills, GIS, Campbell's Soup, CPB, and Kraft Heinz, KHC.
That's the core peer group, yeah.
We see the operational issues at ConAgra, but when we look at the valuation side by side, you said the disparity is shocking. It tells the full story of the market's fear.
It really does crystallize it. Let's use the TTM/PE ratio trailing 12 months price to earnings as a benchmark, looking at normalized earnings across the peers.
Okay, lay out that discount for us.
All right. So General Mills, often seen as maybe the quality operator, the most consistent in the CPG space, trades at 12.64 times earnings.
Okay, 12.6x for GIS.
Campbell's Soup, CPB, is slightly lower but still respectable at 11.33 times earnings.
11.3x for Campbell's.
Kraft Heinz, KHC, which had had its own issues historically but is further along in its turnaround, is at 9.15 times.
9.15x for Kraft Heinz.
And ConAgra, CAG, as we noted earlier, is trading at a PE of just 7.91 times.
Wow. 7.9x versus 12.6x for General Mills. That is massive. That's not just a temporary pricing difference, is it? That implies the market believes ConAgra's future earnings power is structurally impaired relative to its peers.
That's exactly what it implies. And the discount is pretty consistent across nearly all valuation metrics you look at, not just PE. If the market prices GIS at over 12 times earnings, it suggests investors believe General Mills' current earnings stream will probably grow modestly or, at the very minimum, remain stable.
Right. If
ConAgra is priced at under 8 times, the market is pricing in a strong belief that either earnings will decline sharply from here, or perhaps that the depressed 11.0% to 11.5% operating margin they guided for in FY26 will become the new permanent ceiling, that they won't recover.
So deep skepticism about the turnaround.
Deep skepticism. The market is fundamentally skeptical that management can execute this complex turnaround. Specifically, can they execute the supply chain overhaul effectively? Can they drive a lasting volume recovery against a very value-conscious consumer? And, most importantly, can they restore margins back to historical levels, say, 14% or more in fiscal 2027 and beyond? Right. The low PE is basically the market's price tag on that structural skepticism. It signifies the market believes that even the high free cash flow they generate now might be temporary, constrained by the aggressive spending required just to defend against private label and fix these internal operational failures. #TagSeeks. Concluding assessment and final thought.
Okay, let's try to synthesize this investment thesis then for the listener. If you believe the market's profoundly wrong here, that these operational stumbles are temporary, and that the long-term brand equity will prevail, what's the anchor for making a contrarian bet on ConAgra?
Well, I think ConAgra offers a potentially compelling margin of safety, if you're a believer. First, there's that strong free cash flow generation we keep coming back to, and the very well-covered dividend yield, currently exceeding 7.5%. That provides a reliable, substantial return while you potentially wait for the recovery.
Income while you wait.
Exactly.
Mm.
Second, they do hold leading market positions in categories that are actually growing that frozen food renaissance and snacking.
Mm.
And these align pretty well with long-term consumer trends around convenience and even health, like that GLP-1 response we discussed.
Structural tailwinds.
Potentially. And third, the valuation multiples themselves are extremely depressed. They're trading at multi-year lows. This suggests that any successful execution, any sign that they're turning the corner, could result in significant multiple expansion. The bar is set very low.
Okay, that's the bull case. But the essential counterpoint is?
The essential counterpoint is the undeniably high execution risk the investor must accept. We detailed the operational stumbles in chicken production and frozen vegetable capacity. If that volume recovery they're chasing fails to materialize, if the cumulative inflation expected to hit that 45% mark by FY26 persists and they can't offset it,
Yeah.
or if the internal supply chain overhaul stalls or proves more costly than expected, then the stock will simply continue to underperform.
And that attractive valuation.
That attractive valuation just becomes a dangerous value trap.
Mm-hmm.
Looks cheap, stays cheap, maybe gets cheaper.
Right.
You have to recognize that management is absorbing significant short-term pain right now. They're deliberately sacrificing margin to try and buy back volume and fix fundamental operational weaknesses.
Yeah.
It's all with the goal of repositioning the company for what they hope is a more sustainable, profitable future.
It's a bold decision.
It is bold, but it places all the pressure squarely on flawless execution in the next 2 fiscal years, FY26 and FY27.
So, wrapping it up, ConAgra Brands looks like an explicitly contrarian opportunity. It's for investors with a multi-year time horizon who believe the market has become overly pessimistic about the company's underlying brand strength and, crucially, its ability to successfully navigate this self-imposed operational trough in fiscal 2026.
That's it. Success hinges entirely on the team executing flawlessly, or at least much better than they have recently, in the face of historic inflation and those structural private label headwinds.
Okay.
And that leads us nicely to our final provocative thought for you, the listener, to consider.
All right, let's hear it.
We know the company has this long and proud history of dividend payments, maintained them for 50 consecutive years. That's a serious commitment.
It is.
We also know that their entire strategic trade-off right now is about sacrificing stable earnings now to chase uncertain growth later. And that results in that severe margin compression we talked about, down from 14.1% to maybe 11% or 11.5%. So here is the question that really defines the long-term risk, I think. If in the next 2 years, ConAgra fails to achieve its volume recovery targets and the adjusted operating margin stays permanently stuck at that depressed 11% level, what level of future free cash flow generation would actually be required just to maintain that attractive 7.5% dividend yield, assuming the current stock price?
So can they keep paying that big dividend if the turnaround stalls and margins stay low?
Exactly. And critically, how much tighter would their liquidity and their debt covenants become if that free cash flow safety buffer shrinks significantly because margins never recover?
That forces you to really think about the stability of the cash flow versus the company's historical commitment to returning capital, especially under duress. It's definitely a lot to chew on.
Indeed.
Whether you're planning your next shopping trip or your next investment. That was our deep dive into ConAgra Brands.